Welcome to the video. Today we're exploring whether starting young with a $300,000 lump sum can set you up for life. We'll look at historical return assumptions, compounding, tax strategy, and realistic withdrawal plans. We'll also add a clear disclaimer and test your knowledge with quick quizzes. Let's get started. Here's today's agenda. First, we'll frame the big question. Next, we'll break down compounding and run numbers for 30-year scenarios. Then we'll detail tax strategy, clarify dividend taxes versus capital gains, and outline withdrawal approaches. After that, we'll discuss whether this really means you're set for life. Finally, we'll wrap up with key takeaways and a short quiz. Before we dive in, a quick disclaimer. This content is for educational purposes only and is not financial, tax, or investment advice. Markets involve risk, returns are not guaranteed, and your tax situation may differ. Please consult a qualified professional for personal recommendations. With that in place, let's move forward. Now, let's state the big question. If you're young and have $300,000 ready to invest, and you've already secured an emergency fund and eliminated high-interest debt, does that guarantee you're set for life? We'll unpack this with data, assumptions, and sound strategy. Starting early gives compounding the most time to work. Broad, low-cost index funds provide instant diversification and require minimal maintenance, making it easier to stay the course. Reinvested dividends combine with market growth to compound your capital over decades. Keeping the plan simple and automated reduces emotional decision-making, which historically helps investors remain invested through market cycles. With a long horizon, the odds historically tilt in your favor. Let's quantify. We'll use a 30-year horizon and assume nominal average returns in the 7 to 10% range. The future value formula is principal times 1, plus the return rate to the 30th power. At 7%, 300,000 becomes roughly 2.28 million. At 10%, it reaches around 5.24 million. Even the conservative case supports meaningful inflation-adjusted withdrawals if managed prudently. Here's a quick scenario table for a 30-year horizon. At 7%, 300,000 grows to approximately 2.283 million, supporting around $91,300 per year at a 4% withdrawal rate. At 8%, it's about 3.019 million and $120,800. At 9%, roughly 3.98 million and $159,200. At 10%, approximately 5.235 million with around $209,400. These are nominal figures. Real purchasing power depends on inflation and taxes. Tax planning is critical. First, ensure your emergency fund and any high-interest debts are resolved. Next, prioritize maxing out tax-advantaged accounts each year such as IRAs or Roth IRAs as eligible. Employer-sponsored plans like a 401k or 403b if available, and an HSA if eligible. Then place the remainder of the funds into a taxable brokerage using tax-efficient index funds. Prefer broad market funds with low turnover to minimize distributions. Maintain a long-term holding period to qualify for lower capital gains rates and reduce tax friction. Reinvest dividends automatically, but remember they are taxable in the year received, so plan for that cash flow. Let's clarify tax drag. Dividends are taxable in the year you receive them, even if you reinvest through a dividend reinvestment plan. Your brokerage reports these on a 1099 div at year-end. Capital gains generally become taxable when you sell. Holding for longer than 1 year often qualifies for lower long-term capital gains rates. Low-turnover index funds tend to distribute fewer short-term gains, which helps reduce tax drag. Over decades, minimizing tax friction can significantly increase your net outcome. Whether you're set for life depends on spending. With a modest lifestyle, lower annual expenses, and flexibility such as geographic arbitrage, the portfolio could cover costs with a standard withdrawal rate, possibly earlier. With a high-spend lifestyle, luxury housing, frequent travel, and large purchases, you require a larger portfolio or a lower withdrawal rate to manage risk, particularly sequence of returns risk. Lifestyle choices materially alter the answer. This timeline highlights key milestones over 3 decades. At year 0, you allocate the lump sum after securing a safety net and clearing high-interest debt. In the first decade, reinvest dividends, remain in broad low-cost index funds, and manage taxes. Around year 10, at a 7% nominal return, a rough doubling is a common checkpoint. Through years 11 to 20, Compounding continues with minimal tinkering, and the portfolio can reach 7 figures. In the final decade, consistency and staying invested through cycles are crucial. At year 30, the portfolio could range from about $2.3 million to over $5.2 million depending on returns. Throughout, dividends incur annual tax, while most capital gains taxes are deferred until selling. Quiz time. Which statement about taxes in a taxable brokerage is most accurate? Option A. Dividends are only taxed when you sell your shares. Option B. Dividends are taxed in the year received, even if reinvested. Option C. Capital gains are taxed every year, regardless of selling. Option D. Index funds never distribute capital gains. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, dividends are taxed in the year received, even if reinvested. Capital gains are generally taxed when you sell. Index funds can still distribute capital gains, though low turnover helps reduce them. For withdrawals, many start with the 4% rule as a heuristic, though it is not a guarantee. Alternative frameworks include guardrails, or variable spending, that adjust to market conditions. Sequence of returns risk is most acute early in retirement, so managing withdrawals and maintaining flexibility is essential. Tax-aware drawdown, often spending from taxable accounts first, then tax-advantaged, can extend portfolio longevity. Maintaining a 1 to 2 year cash buffer helps reduce the need to sell during market downturns. Second quiz question. Roughly how much could $300,000 grow to in 30 years at a 7% average annual return? Option A, about $1.5 million. Option B, about $2.3 million. Option C, about $5.2 million. Option D, about $10 million. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is about $2.3 million. Using the standard future value formula, with a 7% return, $300,000 grows to roughly $2.28 million after 30 years. Here are the key takeaways. Start early and stay invested. Use broad, low-cost index funds. Plan ahead for the annual taxation of dividends. Defer capital gains by holding long-term when appropriate. Whether you're set for life depends heavily on your lifestyle and spending. Finally, withdrawal strategy and tax-aware drawdown are crucial in retirement. In summary, a $300,000 lump sum invested early can plausibly grow into $2.3 to over $5.2 million over 30 years under historical return ranges. Broad, low-cost index funds provide diversification and align well with compounding. Effective tax strategy is essential, as you cannot shelter hundreds of thousands at once. Whether you're set for life ultimately depends on spending, flexibility, and the discipline to stay invested. Now let's close with a final note. Thanks for watching. If you found this helpful, please like the video, share it with someone who's planning for the future, and subscribe for more deep dives. What would you do with a $300,000 head start? Share your thoughts in the comments.